Perfect. Thank you very much. Like Nikhil said, my name is James Romero, and I work under One America under the Care Solutions division. And yes, today we're going to focus on an annuity product that we offer that can help you satisfy some of your clients' long-term care goals in their overall portfolio planning. So wanted to start off, just like Nikhil said, we are going to have a question and answer period at the end, so feel free to hold on to your questions and be more than happy to answer anything that may have come up during the webinar and the presentation. And also, we'll go into just a little bit of the marketplace of long-term care. So just to start off, I don't know how many of you have ever looked into selling a long-term care policy or know of someone that was talked about selling a long-term care policy. But general experience is it's not an easy sale. And there's always a few different objectives that can come about it. But just to give you a little background on the traditional long-term care market, about 30 years ago or so, when a lot of insurance companies came up with the concept of offering traditional long-term care, it's based off what's called a lapse premium product. Similar to that, if you think of car insurance, the lapse premium product, meaning they need X amount of customers to pay their premiums and not go on to care, not need to go on claim for several times. So they can take those premiums, invest them in the portfolio. That way they have capital to cover the claims on those that actually do end up needing the care. Well, what happened is they opened this up for an age range of 50 to 80 when they first came up with long-term care. But what happened was when they opened up to 50, 80, who do you think was the age group that was actually looking into and purchasing long-term care? Well, it actually was those in their 70s and late 70s that actually purchased it. And that makes sense. When you're in that age group, you are more thinking of long-term care. When you're in your 50s, maybe in your 60s, what are you more focused on? Probably retirement, maybe still finishing, putting kids through college. So it's not really something that's on your mind. So what happened was a lot of these long-term care insurance companies were getting into trouble and were on the hook here for a lot of potential claims that were going through without getting the premium they needed to sustain being able to offer these types of policies. So what happened is they had to sort of price the older group out of the market. So some of those items that they had to do was, one, they had to make underwriting a little bit more difficult. For example, if someone has diabetes, it's really difficult to get a long-term care policy nowadays. So they made underwriting a little more difficult. They increased premium costs for those in the older ages. So now it's been made pretty expensive when you're in that age group looking to get long-term care. It's pretty difficult to get. And then also, just overall, a lot of people feel the premiums are too high. Premiums are likely to increase, so there's no guarantee on what their premiums will end up being. So over the last 5 years, what do you think? We're in a growing, aging population. Modern medicine is advancing, so people are living longer, so that's much more likely that you would need long-term care. But with that, over the last 5 years, do you think we've had growth in long-term care policies sold, or have they declined? Well, the truth is they've actually declined every year, each year for the last 5 years. And the reason why is a lot of the reasons that we just went over, being priced out of the market, being difficult to get. Those that really want to target and really want to purchase long-term care, those in their 70s, are just having difficulty coming about it. So really leads us into an opportunity of how we can use asset-based planning for your long-term care. So just a little about us. We provide asset-based approaches to protect against the costs associated with long-term care. We use an annuity and also a whole life foundation as well. As the Care Solutions division, we've been in the market for over 20 years. A few of the items we offer asset care, Annuity Care 2, Legacy Care, and Immediate Care. But for today, we are just going to focus primarily on Annuity Care. So just give a little background here on annuities. I believe there is about $1.57 trillion that are in annuities today in the U.S. And we average to do about 100 to 150 billion in annuity business per year. And a lot of that was created back in the early 2000s and also through 2007, 2008. We were in an interest rate driven market. We were looking for the best rate, trying to lock in those rates for a period of time, and that's why we had such a surge in annuities and why it was such a hot product. Well, lately, now that rates have dropped, and they're actually really low, that market sort of dried up. You can't really find the rate, and with guaranteed minimums being as low as they are, some of them down to 1.5% to 2%, and you've got an out-of-surrender annuity that's got a guaranteed minimum of 3%, well, now we can't 1035 that annuity because we can't go from the higher rate to the lower rate. So the interest rate market has dried up. So now we're more in a value market. We got to find annuities that have added value to give you a reason to do that 1035 exchange. So that's where Annuity Care can really give you that opportunity with what we have available in terms of 1035 exchanging an out-of-surrender annuity. Now, the average age of an annuity, someone holds an annuity, is age 66. And if you think about it, that makes sense because what happens around age 66? Well, retirement. That's right. And what happens at 66 is people start to be able to receive Social Security income. So people start to take out annuities because they're hiding assets. If you have too much earned income, that can affect the amount of your Social Security income that you receive. So a lot of people start to take out annuities so they can hide assets and not have their Social Security income deducted into. So what happens typically, someone takes out this annuity and they keep it for 6-7 years or so. And what do? Well, most often they don't withdraw from it because, as we know with annuity, if you take a withdrawal, it's last in, first out. That interest is going to come out, and they're going to pay taxes on that. It's like, okay, I better not do that. I'll just leave it here. So they end up either leaving it or they 1035 exchange to a new annuity, and then it gets deferred on from there and there. So you have people really that have had annuities for 10, 15, 20 years that have just been growing tax-deferred, and you're building up this large taxable gain in there. Well, what ends up happening is because of the taxes, people end up not ever touching it. In fact, there's a question for you, and you don't have to answer it, I'll tell you. I want to think, what is the percentage you think of people or annuities that people die with them in force? And I'm sure you know it's very high. You might be thinking maybe 70s or 80s. But actually, it's about 95% of annuities end up leaving in force when the person dies. And makes sense because no one ever wants to pay the taxes on that. So that leaves you an opportunity there with a 1035 exchange because in a Gallup poll I was taken in 2009, 81% of those annuity holders, they stated that their annuity is sort of their just-in-case money, so their rainy day, and they would use it for long-term care if they could. So that is huge because the amount of money that's in annuities and people that have annuities in this age group that would use it for long-term care, you now have an opportunity to be able to take advantage of that and reposition to something that can do that. So with Annuity Care, just to go over some of the basics, it's just a fixed annuity. It offers tax deferral. You have your cash value growth. The death benefit really is just the cash surrender, the cash accumulation value, and then the option of income. But what makes it different is it acts as a regular annuity, so you're going to continue to receive your growth, right, and it doesn't miss a beat on that. But then it has an enhanced value if you need it for long-term care. So it allows somebody with that just-in-case or rainy day money to plan for long-term care. It's funded with existing annuities or other conservative assets. Money grows in two ways. So this, we just had a rate change June 1st, so this has not been updated to reflect that. But you have two ways of it growing. You have your long-term care growth, which is now at 4.05%. And then you have your cash value growth at 3%. Think of the long-term care fund as sort of an income fund on maybe an indexed annuity or a variable annuity. It's sort of this separate balance that grows at a separate rate, but if you need it for a purpose as long-term care, you'll have this higher balance that's available for long-term care while your cash is growing at 3%. If you were to take advantage and need this for long-term care, the policy gives you a 36-month benefit, and that is out of 2.9% of whatever the long-term care fund has grown to at the time. Now, we're going to take a look at an illustration and give you a breakdown in a few minutes so you can actually see the functionality of having an annuity care, see how it grows, and how the benefits can be used. Okay, so just to give you a little bit about this now, and I'm going to skip ahead here to the Pension Protection Act and how this all came about. Now, in 2006, the Pension Protection Act, it amended what was called HIPAA and the HIPAA guidelines that were created in 1997. So HIPAA is what really created what's called qualified long-term care. It set the guidelines on what would be tax-free for long-term care, how you can qualify to receive those benefits for long-term care, such as the 2 out of 6, requiring assistance with 2 out of the 6 activities of daily living or severe cognitive impairment. It also provided for an outline of coverage and also certain tax deductibility guidelines for qualifying long-term care premiums. Well, what the Pension Protection Act did in 2006, it amended that law to allow for annuities, specific non-qualified annuities, to have their cash values accessed tax-free to cover qualifying long-term care expenses. Now, that law that was created in 2006 just went into effect January 1st of this year. So with that, of course, we've seen a surge in annuity care because now you have the ability to move out of surrender non-qualified annuities into annuity care. And if you do end up needing it for long-term care, you can access those values on a tax-free basis to cover your qualifying long-term care expenses. So just a little bit more on the Pension Protection Act. The legislators see it as a way that long-term care could be a central financial problem facing seniors. We have a growing aging population, people are living longer, and the government just cannot afford to cover the cost through Medi-Cal in California or Medicaid in other states. So what they're doing is coming up with ways that we can use their own assets to be able to cover their long-term care, and by adding tax incentives, helps that out and takes the burden off of government funding. So we have these types of products like annuity care that give you an advantage to be able to take advantage of that on using your own money. Let's see here. With the annuity care plus, just to let you know, now with I mentioned earlier that annuity care, if you were to go on a claim for long-term care and need to use the funds out of there, it would last for a 36-month period or 3 years. Well, oftentimes, and you're working with that with your clients, say, well, what happens after 36 months when I'm still on claim? Well, the annuity is depleted, but we have the option going into this. You can purchase additional coverage. You can actually purchase an additional 36 months, or you can even be covered up as much as lifetime coverage. There's a premium that you'd pay separate to do that, but it is an option that's available. You can choose to pay that annually if you'd like. You can pay it lump sum in a single premium. These premiums would never grow. They've never increased in cost. It's non-cancelable, meaning it would be whatever the cost is now, it would be the same cost 10 years later in order to purchase and pay for the long-term care extension. Okay, so I think, let's see here. Now's a good time. We can take a look at the illustration. So I'm going to pull this up here. Okay. Okay, so this is based off of a 72-year-old female using $103,500 of single-base contract premium. So from day one, with the $103,500 premium, remember the monthly benefit is 2.9% of whatever the value is. So day one value of $103,500, 2.9% is $3,000 a month. Now this is going to cover assisted living, home health care, a long-term care facility, adult daycare, or hospice. There's not a reduced benefit for home health care. With all the qualifying types of care would still get the equal benefit that's available to you at $3,000 a month. We offer something called an annual bed reservation. What that means is oftentimes if someone's at a long-term care facility, those facilities only provide minor medical treatment. If somebody became quite ill, maybe with pneumonia, and needed to go to a hospital for a few weeks, we'll actually make sure to pay and reserve their spot at their long-term care facility so they can receive treatment at the hospital and they have a bed to come back to when they're all healed up and ready to come back. The annual respite care, what this is for is just substituting care. This is somebody that is not on a claim but is being cared for by a family member, but the family member needs a break. For 21 days out of the year, they'll have a professional come in and substitute for the caregiver. Now, annuity care, what's great about it is it only has a 7-day waiting period. Typically, on most long-term care policies, you see 60 to 90 days. but this one is just 7 days. So your clients are able to access their funds for long-term care at a much quicker pace.